How to use options and statistics to trade earnings. Opportunities during earnings season. Earnings season provides a bevy of opportunities for options traders due to the rise and fall in implied volatility, larger than average directional moves, trend shifts, trend following opportunities, and more. The best part is that these opportunities occur quarter over quarter regardless of market conditions. I like to trade a combination of opportunities. Three distinct earnings opportunities that I love include trading pre earnings momentum, overnight earnings moves, and post earnings moves. Depending on the flavor of the season, I'll shift my focus depending on the weather. What does that mean? Well, it means that some quarters you're going to see a lot of pre earnings momentum. Other quarters you're going to see more overnight earnings moves. And still, other quarters you'll see a lot of big post earnings moves. You never really know going into each quarter what you're going to see more of. But once you start seeing those setups, you have to jump on those trades. So I like to equate it to the weather, and I also like to call it the flavor of the season just because, well, the flavor changes just like the weather. At the end of the day, trading earnings is really all about volatility, and that's something that earnings season has a lot of. When you look at the variety of opportunities that there are in the stock market, especially for earnings traders, you're going to see opportunity for directional traders where, you can attempt to capitalize on an up or down movement in price action. You're also going to see opportunity for neutral or income traders where you can capitalize on sideways price action. This is especially true for overnight earnings trades. But as I mentioned, more than anything, you can really focus on volatility throughout earnings season because volatility is going to rise going into the season and fall afterward. So, what is volatility trading? The objective is to profit from changes in volatility, regardless of the direction in which the price of the underlying asset moves. What are some key characteristics? Well, volatility focused. These strategies are based on predictions about the future volatility of an asset, not necessarily its price direction. Volatility can be historical, statistical, or implied, derived from options prices. Common strategies that you can use when trading volatility include straddles, strangles, and iron condors. Both buying and selling options can be used to exploit different volatility conditions. What's great about volatility trading is that you can use it throughout different market conditions. There are going to be times where earnings season occurs in the midst of a strong bull market, in addition to occurring in the midst of a strong bear market. It also occurs during choppy markets and violent markets as well. So, what's great about trading volatility is that, you can use these strategies regardless of what the market is doing, and you can use it on a calendar based system. Traders might expect, for example, a surge in volatility before an earnings announcement or significant event, and a decrease in volatility post event or in stable market conditions. One thing that is great about earnings season is that premium decays rapidly over earnings reports. While you have a rise and fall in implied volatility, you also have a premium crush effect, especially if you're trading options the same week as an earnings report. Options are going to lose value over time due to premium decay, but this effect is even greater over an earnings report because the volatility is being crushed along with the premium. This is why you need statistics. And let me tell you, because I love trading patterns, technical patterns are great, but earning setups with a combination of statistics are even better. It's because regular trading patterns just can't be quantified in the way that most others can. And this is because they fall on the calendar. The squeeze, nor does any other setup that I trade fall on a calendar in this manner. As much as I love Fibonacci, it's not something that I can really put into a Thinkorswim tool and have it give me statistics based on which fib levels work better, which time frames work better, and I certainly can't center them around earnings reports. So, why would I sell premium over earnings? Well, it's because you want to capitalize on the fact that somebody else is purchasing these options, and you know how implied volatility and premium decay work, and you know they will likely be worth less than they were before the earnings report. You want the credit that you sold to slowly slip away, which will give you a profit. How about identifying opportunities with stats? I use statistics for a few reasons. It's better than a backtest. You have real time data that you can crunch to see exactly what you're looking for. You can alternate between patterns based off of what you're in the mood for trading. Now, remember, we discussed the top earnings setups that I use. I like to use pre earnings moves, overnight earnings trades, and post earnings moves. So, of course, that means that I need statistics for these three setups. How do I get statistics? Well, it's all about having and knowing what your trading setup is and then quantifying that. I do this through my custom tool called the Earnings Hot Zone. When you look at the hot zone, you're going to see a lot of data, but let me break it down for you. When you start off, you can see the stock over here, right? This is going to be Costco. So you can see Costco right here. You can see the current price. And then under here, you're going to see a bar with a summary line of stats. You can see how many quarters you're analyzing. You can see the fact that this is a daily chart. You're analyzing 11 of the last quarters. Costco has beat estimates 8 times out of those last 11 quarters and missed estimates 3 times. Then you also have a summary line of the statistics that are displayed down below. For example, you have a pre-earnings and post-earnings time frame that's notated with these bars. The first bar is going to be the 21 bar time frame before earnings. The second bar is going to be the 8-day time frame before earnings. The third bar is going to be the 8-day time frame post earnings. You can see that these bars are changing colors. This one's green, this one's red, this one's green. If it's green, it means during that time frame, the stock traded higher. If it's red, it means during that time frame it traded lower. If it's green, again, traded higher during that time frame. And it's yellow if it was neutral during that time frame. So what this tool does is it crunches the data over the amount of time that you want to look at. I selected the daily chart with 3 years of data, so that's why this is how much data that I'm getting. And you can see individually per quarter what the stock did during those time frames. So for example, last quarter, it traded lower before earnings, but then after the earnings report came out, it gapped up. Well, it actually gapped down negative 0.2% initially, and then after that, it rallied and traded higher. So initial slight gap and then rally higher. Quarter before that, you can see that during the pre-earnings time frame, it traded lower, and then during that post-earnings time frame, it was flat. It had an overnight gap of 2.2% to the downside. Quarter before that, it traded lower before earnings and also after earnings. Again, experienced another negative gap. You see where I'm going with this, right? So what this tool does is it's going to show you quarter over quarter what the trends are, and then the summary bar at the top is going to demonstrate, well, the summary of those stats. Additionally, you can see that there is going to be volatility down here. The earnings volatility is going to demonstrate how that volatility has shifted over time. So you can see how volatility climbs higher going into that earnings report and then it rolls over afterwards. You can also see that during moments in time where the market is rolling over, the volatility is especially high, but still it rolls over after that earnings report. So this tool is, a multi-layered tool. You have quite a bit of data here. You also have another summary line that is going to crunch the overnight moves. This is what I use for my overnight earnings trade and gives you a lot of different opportunity between the pre-earnings moves, the overnight moves, and then the post-earnings moves as well. There's just a lot that you can do here with this tool. So let me go ahead and show you a brief demo. Here's a live chart of the same chart that I was just showing you as a screenshot. Here's Costco. What you can do with this is, you can really zoom in and you can really see what the price action is doing here. You can see, when a stock has actually moved and started off right here going into earnings and ended up trading lower going into that report. You can see the way that the volatility rises and falls. So, you can see that the volatility is really going to start climbing really around that 21 bar time frame just before earnings. That's why we call this entering the hot zone. It's really where you're going to see that volatility kind of start to spike. So that's how I like to time my earnings trades, especially if you're going to be using any sort of pre-earnings momentum. And I also like to combine those with my stats. So, for example, with Costco, you can see that on average, Costco falls by about $18 going into earnings. So, what does that tell you? It tells you that, if you're going and you're entering into the hot zone, there's a pretty decent chance that it will fall going into earnings. Now, you might look at this and say, well, that's crazy because you can see that, the last, 5 quarters in a row, it's fallen going into earnings. So should you look for that this quarter? Well, what's interesting about Costco is that Costco actually had this massive move post earnings. Sometimes what you'll see with a company when it reports earnings, especially the move was, if the results were better than expected and the move was better than expected, sometimes you'll see a high volume push and just a breakaway rally. And when that occurs right after earnings, then oftentimes you're actually not going to see that earnings pullback. So I think this quarter was a little bit unique. But the main thing that I like to do with Costco rather than trade it pre earnings, because I just don't generally find that it has a great pre earnings setup, I usually like to trade it overnight. That's because when you look at the implied volatility, you can see that the implied volatility rises quite a bit going into earnings and then it rolls after. There's other setups that I generally prefer for pre-earnings trades. Those are going to be ones where your stats are a little bit more solid. So for example, on Meta, you can see that during that pre-earnings time frame, on average, it trades higher by about 5.66%, which is about $16, $17. So this is one that I'd look at and I'd say, okay, we're entering the hot zone right now. We also have a squeeze. You can see that volatility just really picking up. So that's something that I would be interested in to trade to the upside. Another one is going to be Google. Google's pulled back just recently, but if you look at it from a statistical standpoint and you kind of overlap that with a setup, you have this squeeze. You also have an increased implied volatility, and then you have these stats as well that say, hey, you know what? This stock has been trading higher going into earnings, especially recently. You've also had 2 recent post-earnings gaps higher, and you have these overall stats that demonstrate that this is pretty typical. Another thing that you have with Google is the fact that the implied volatility is actually pretty historically low. Um, you can see that it's gotten much, much higher going into earnings. Obviously, some of this was during the bear market, but even more recently, we've seen some pretty big IV spikes. So what that means is that there's still more room to run with Google as far as this implied volatility is concerned. So I really like this tool. I use it all the time for pre-earnings trades, overnight trades, and post-earnings trades. I think that the statistics are really helpful no matter what it is you're doing. And you might often look at a stock and say, hey, there's not really a statistic backing it up, like Hershey's, for example. This is demonstrating that this stock is pretty much completely flat going into earnings, that just means that that's not really a candidate to use for a pre-earnings run because it doesn't have any stats behind it. So it can also keep you out of trades in addition to getting you in trades, which can be even more important. So, thank you very much for joining me for this section about earnings and earning statistics. Understanding how earnings patterns work is really critical. Then after that, traders can learn more about how to utilize these patterns to their advantage by incorporating statistics and proper option strategies. Thank you very much for joining me, and I will see you in the next episode.
Hey traders, if you love this video and want to take your trading to the next level, come join us in the Mastering the Trade room. This is where I focus on low risk, high reward strategies along with the rest of our trading team. You're going to find live charts, live analysis, and live trades always made with real money. Click on the link in the description to join our community and learn more today.